Dr. Joe Cook here with the fifth and final installment of the GE analysis. And of course, this isn't a complete analysis. It's just illustrating some of the ways that you can apply what you've learned. So we're going to do a Dupont analysis, and this formula is not correct. There we go. So the Dupont analysis starts with the equity multiplier, which is average total assets divided by average equity. So if you look at this formula, I took beginning of the year assets, which is end of 2020, plus the end of 2021 and averaged them. So divided them by 2. And then I also took all of the equity excluding preferred stock and averaged those and came up with a factor of 5.78. So that's the equity multiplier. And then I wrote myself a little note here that said, this was the extent to which return on equity changed that was due to long-term debt, basically. So 5.78 is the factor. The profit margin, I took right from the income statement. So this is 0.09, negative 0.09. And so if you look at 2021's profit margin, it's 0.092 something. And we can see a little bit more of that if we expand that cell formatting, but we don't really need to get that precise. So the asset turnover, the asset turnover was from the income statement, sales, net sales, divided by average assets. And all of these things you can look up, or they're in lesson 2 from this unit. So those are the 3 components of the Dupont analysis. I computed each of them here, multiplied them together according to the Dupont analysis formula, and I come up with return on equity. Let me just double check this. So it should equal return on equity based on the traditional calculation, which is right here. So I did this return on equity the traditional way, which is net income divided by average equity. That's slightly different because this is using total equity, but notice it's 17% basically. And calculating using the Dupont analysis, it's 17%. And I'll just quickly eyeball the others. They're all about the same. There was only $6 million of preferred stock outstanding. So that didn't really affect the calculation very much. So let's look at 2020's Dupont analysis. The return on equity of 17.5%. A majority of that is from paying off debt. Again, this is what Lawrence Cope was trying to do, was basically pay down debt in a nutshell. And so the profit margin contributed a little bit to return on equity, and so did selling off assets. So the Dupont analysis tells me return on equity was 17.5%, and that most of that is from reducing debt. And so what you can see here is that once you get the information into Excel, there are almost endless ways to massage the data, to recalculate, to add to the data. You could do the same for the statement of cash flows, calculate free cash flow. You could put some of the other statements on here, but these are the major ones. The income statement, the balance sheet are the major ones that you would probably be analyzing. And that is the GE analysis. One more thing that we would do as we were doing this GE analysis, of course, we would go to the notes to the financial statements and read them carefully, because they're going to give us a lot of the information that's going to add to our analysis. Let's see, there's there's so much information here. I don't want to sit and go through it while you're watching this. But here's something. Hey, look at this. We have reclassified prior year amounts to conform to the current year's presentation. That's always nice to know. Somewhere in here, and it might be the best place to find it, might be in management discussion analysis. It should tell us some information about the different segments and what they're doing. So what I'm looking for is usually they have a list of their different business segments, but I don't see it right here. It's not just jumping out at me. But you could find that information, find out what the sales of services are for, what the sales of equipment are. I think they're jet engines, and add to your analysis so you have a quantitative analysis. And then you should also have a qualitative analysis where you analyze this information. For instance, the Z-score, alarming. Why? Is it all by itself? Does it mean the company is going to go bankrupt? I kind of doubt it. Look how much cash and current assets this company has. It does have a lot of debt, especially a lot of debt, total debt compared to equity. It's heavily leveraged. This is a heavily debt financed company and has been for a long time. And again, it looks like Culp is working on getting that debt paid down as fast as he can. All right, that's the GE analysis in a nutshell. So go out and do great things with this.